Chris. Thanks for coming on.
Oh, thanks so much for having me.
First things first, I want to give you a compliment for something, which is that of all the fund of funds that I've engaged with since launching my own firm, you are the fastest person to respond every time. You have the fastest response time. So that's impressive.
You know, I'd like to say that that's something I did with intent, but the reality of it is that I've used every productivity expert will tell you that this is the worst thing you could do. I use my inbox as a to-do list. And so I'm just like trying to process things and you got a response, which meant I was excited, but like a lot of things just get filed. And then what happens though is the bottom of my to-do list never gets any attention because I'm always responding to the important, but then I leave or I'm responding to the urgent, but then I leave the important for later, and it just sometimes languishes. So,
well, don't beat yourself up, but I do appreciate it. It wasn't lost on me.
Well, there we go.
So maybe to get things rolling, how about you just tell listeners about Ahoy Capital and what you're about?
Sure. So Ahoy Capital is a fund of funds, and we focus on investing in smaller managers. There's a lot of smart people out there who are focusing on different aspects of the venture ecosystem. But I and my partner Cliff historically have been at the front end of, we've invested early in some, kind of, I guess you'd call them category defining, venture firms earlier in our career. And part of what I really enjoy is investing in kind of small emerging firms. And so when we launched Ahoy, when we spun out Ahoy from our old shop, we were excited to kind of continue that tradition, and that's the area of focus. So we invest in about kind of a concentrated portfolio typically, and try to outsmart some of the smartest people on the planet.
All right, sounds fun. And for listeners who are maybe operators or new to venture, can you kind of walk through where funded funds fit in the ecosystem and the problem they're trying to solve?
Yeah, it's a great question, and one that doesn't get a lot of attention, kind of from me because I marinate in this, but we're kind of the money behind the money, right? Ultimately, there's we're intermediaries in both the best and worst sense of the word. So, an entrepreneur typically who's looking for funding, he or she might go and look for funding for a venture capitalist. Venture capitalists get their funding from someplace. And so either those are, institutional investors like university endowments or foundations or pensions or, et cetera, or high net worth folks, or, kind of fund of funds. And the role of a fund of funds is to aggregate capital on behalf of people who might not otherwise have the desire, interest. They have humility about their capability in terms of their market. Knowledge, or might even just want to kind of augment a specific exposure. So we aggregate capital from a handful of typically institutional investors, people who actually, in our case, we're very lucky because we have a very tight-knit group of very sophisticated investors who have venture portfolios already, but are looking for us to help them build out their exposure in kind of new and emerging groups.
Okay. So we're both CFA charter holders, pretty rare thing in venture. I feel like I've just bumped into a unicorn in the woods. So maybe to ask kind of a wonky question, but you're an alpha guy. You've talked about that. That's how your fund is set up and the structure. I get the sense that most fund of funds are, we'll say, beta driven and a little more maybe access driven, or risk adjusted is a kinder way to put it, but very beta. And I'm curious, is that a fair opinion?
Look, I can't speak to anybody else because I don't know the voodoo that people do specifically, and I can only kind of talk about what I do. But it's interesting because kind of even stepping back a little bit, if you think about it at some level, I've always thought, and we can get in a philosophical discussion about this, but we'll spare everybody's years and time, is venture just a super beta asset class, right? And we could talk about kind of the philosophy of that. The way I look at the world, is there are a lot of really smart people out there who do what I do, who offer access to great funds. The problem is that there's this what I call the venture industrial complex, right? And there's this kind of flywheel of funds that are getting bigger, and the people who fund them are happy that they're getting bigger. Because then they have more, kind of more capacity to accept the capital. And that's not just fund to funds, that's institutional investors, kind of CalPERS has to have some place to put its money, right? Washington State Investment Board, right? A lot of really smart people, but just have big checks to write. There's an old saying that in venture that your fund size is your strategy, though, right? And so for us, we've been like intentionally focused, kind of on smaller groups, because I actually look at the world as kind of pre-Excel, post-Excel, right? The second somebody can plug a startup's, kind of financials into Excel and start analyzing it that way, there's a lot of smart people, doing that, and you can like figure out, what the value, of a given company is. What we're looking for is groups that are investing, groups that are investing in startups that are kind of pre-Excel. So really kind of at the idea, pre-seed, seed, at the idea stage, the first, kind of dollars that will go into these companies, sometimes even before, they have an idea, kind of they'll have a product idea, but maybe haven't iterated on it that much. Because I think that, Peter or whoever wrote the book 0 to 1, I think that's the true alpha you can get in financial markets, like the truest alpha. And because that 0 to 1, I almost imagine it as like, Adam and God on the roof of the Sistine Chapel with their fingers, just kind of almost touching. You can almost sense the electricity. That's the 0 to 1 moment. That's like the true alpha. Once you go, 1 to 10, 10 to 100, and those are kind of metaphorical, not revenue or whatever, but just, 100 to 1,000. In all of those, you can actually like project something, and you're making a bet, that's somehow market related. But in that moment where you create something that's never existed before, that's the truest, definition of alpha. And that's my jazz. That's what I get excited about.
For GPs, a typical formula people talk about for winning is some mix of sourcing, picking, winning deals, and supporting founders after that. What does that formula or recipe look like for a fund of funds?
Do you mean at our level or?
Yeah.
So it's interesting because, again, different people take different tactics. And I've been, I started my career at Princeton University, which was, at the endowment, which was itself a fund of funds, right? If you think about it, with a single client. And then I was at a fund of funds for a little while early in my career. I was at Princeton from 01 to 04. And then after that, I was at a great place called TIFF, where we managed money on behalf of a consortium of nonprofits. And so I've seen like a bunch of different, kind of ways to skin the cat. And I've been fortunate in that I've been at places that are very, think of themselves as very catalytic. But the reality of it is that like a lot of institutional investors, fund of funds, anybody, they've got, a lot of investments, and a lot of, their attention is scattered. One thing that I really enjoy doing, though, is really focusing on, early managers and helping them, kind of helping them set their own DNA. And that doesn't mean kind of injecting my DNA, but rather kind of keeping them focused on the, on what is authentic to them and how they can build sustainable competitive advantage based on what the things that are authentic to them. And it's not just the managers that are in our portfolio. I spent a couple of hours yesterday talking to somebody that I've just known through the business. We're not an investor in their fund, unlikely that we will. But we spent some time talking about how they grow their firm. What the next, kind of 5, 10, 12, 15 years look like, and how they think about the choices that you make today, because strategy is an integrated set of choices that inform timely action. Right. That's the Mike Porter definition that was hammered into my head before business school in the late 90s. And so so and one thing I tell people all the time, and this is very generic advice, but it's actually like really important, and not a lot, a lot of people they kind of go and do without thinking first. And what I always say is, like, I almost feel Yoda-esque, like, begin at the end you must, right? And kind of start at like where you want to be and then work backwards from that. And that's like the conversation I had yesterday with this young GP for a couple of hours, and I said, let's have this conversation again. And that's kind of the stuff I love doing. I just, that's kind of what I view as my role in the ecosystem. And I've been fortunate to meet a lot of really interesting people who are super thoughtful about stuff. And we haven't invested in all of them, or even, kind of very many of them. But hopefully I've helped them on their journey.
You're a big proponent of concentration, which is pretty non-consensus within venture. Is there an event, or was there a moment that kind of sparked you heading in that direction as an investor?
It's funny because I actually was fortunate. So David Swenson is this kind of guru of institutional investing, and he was the endowment chief at Yale for 30 plus years, I think. And I was really fortunate to take his class on institutional investing when I was in college. And one of the things that he said that really stuck with me was, he said, investing is about optimizing discomfort. And that really, he said, if you're doing comfortable things, you're not getting the right compensate. You're likely not getting the right compensation for them, because everybody else in the market is doing that comfortable thing, and that prices that asset up. And I thought a lot about that, and it didn't really actually click in my kind of venture thinking until I talked to Will McLean, who is kind of the longtime endowment chief at Northwestern University. Super smart guy, super nice guy. And Will said something to me that kind of congealed with what Swenson had said. And he said, Will said, most investors aren't diversified, they're diversified, right? Because they're over diversified. And the problem is, especially at my layer, where I'm investing in funds, and then those funds, and so I've got a portfolio of funds, and then those funds themselves have a portfolio of, 20, 30, 40, up to 60, 70 startups, right? So when you start aggregating up those exposures, I'm starting to dilute the effect of the big winners, right? And there's a lot of debate about power law now, and like all you need is one, but I have strong views, kind of about that. So you need to be appropriately, concentration is a function of conviction, right? And if you get excited about things, then you can be duly concentrated, and that should, that mitigates some of that layering that I have. And by the way, I'm always cognizant that my investors, I'm part of their portfolio. So if there's a portfolio company that does really well, does it move the needle of the GP in whom I'm invested? Does it move my needle? Does it move the needle of my investors? And that's, kind of a debate I'm constantly having.
I want to read something out from your investing values and see if I can get a good ramble or rant out of you. So,
okay.
We often cast a jaundiced eye in the direction of frothy company or sector valuations. This value-esque bias paradoxically tends to guide us to frontier technologies and startups at their earliest stages. I love a good paradox, and this feels like a good one to set you up with on the heels of what you were just talking about.
Yeah, and it's interesting. So, by the way, one thing that's related to the last thing I said, and is almost a transition to this, is so many people. Another thing that I spent some time talking to David Swenson about in the 90s and early O's was, most people are afraid to be wrong and alone, right? This is Lord Keynes famously said, in matters of reputation, it's better to fail conventionally than to succeed unconventionally, right? And that kind of mindset, and then Jeremy Grantham said 85% of investments in finance are first motivated by career risk, right? And there's a lot of people out there who are happy to do the conventional thing, and seek validation from being with the crowd. And I think that's social proof. The social proof is particularly acute in venture. And it's fun. It's fun to do kind of the cool hot thing. And on top of that, by the way, like, people fetishize the doing of the deal, right? One of my most hilarious moments in venture was I gave this talk at the NVCA annual meeting. I think it was like 2014. And I got up there and I put up the Daily Wire from Dan Primack, and it's, said, here are all the deals that have been done, right? Like there are 30 deals that were done that day, and here are the IPOs, and it was blank, and here's the M&A, and it was blank, right? And we have such mortality in venture, and that's to be expected. But like everybody high fives themselves when we do a deal. But like what I care about is the moolah and the kula. And at the meeting, what I did is, Mark Andreessen was in the front row, and they just backed this company called Genius. And so I put up the Genius was a lyrics annotation company. I put up their annotations for the song Method Man by Method Man. And all these guys are talking about how to, how they would torture enemies at the beginning of the song before it goes in the riff. They just like are and I think RZA, or one of the Wu-Tang Clan says, yo, I'm gonna sew your butthole shut and keep feeding you and feeding you and feeding you and feeding you. And I said, that's what it feels like to be an LP in venture, right? Like we just keep feeding the snake and nothing's coming out of the back end. Right. And on the hedge fund side, like the joke is like Miller Motor Cars is like the fancy, dealership in Greenwich, Aston Martin, blah, 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 all the fancy things I don't even know. And the joke that my hedge fund colleagues, used to make was, Miller Motor Cars doesn't accept relative performance as a form of payment. Right. Like at the end of the day, it's about the moolah and the kula. And I think sometimes in venture, the venture industrial complex loses sight, of how important, the actual returns are. Now that's not really the question you asked. The question was a little bit more about kind of idiosyncrasy. And that goes to this, and I'll get off my soapbox in a second, but that goes to one of my favorite.
Stay up there.
Yeah, there's this great Buffettism, which is opportunity equals value minus perception. And I think, in the public markets, we see, value with a capital V, like what is the value? And so like, we were talking earlier about, CFA charters, in the public markets, you can have disagreements, but, there is kind of the standard deviation around like what is the value of a company is pretty tight relative to venture. And so like, as the perception of that, kind of grows, that go forward opportunity shrinks. The problem is that relationship doesn't exist in venture because of stale prices, and because there's almost this like recursion between like value and perception. Like because something's perceived to be hot, it's perceived to be valuable, and that kind of is this flywheel that sometimes creates its own like breathlessness. But at the end of the day, that and that articulates itself in price. But I've seen so many companies. A long time old timer in venture once told me, he said, venture is the business of heartbreak. The number of companies I've seen go, kind of parabolic and then just kind of fizzle and run out of steam. It would take all my fingers and toes times 10, like the number of companies that I thought were going to be fund returners that ended up, kind of fizzling. Not just in my portfolio, but across portfolios. So for me, the question then becomes like, how do you blind yourself intentionally to, the kind of fervor of the moment and instead focus on the sustainable value of a business, right? And so in our articulation, that's like, okay, what are the barriers to entry? Right. Like that's something that not a lot of people think of, particularly in the period we just came out of, where people were like weaponizing balance sheets and you could like throw money at a problem and incinerate a whole bunch of capital. And that's great for the startup, and it's great for the venture backers who, invested in it because they look like stars because their company's on the front page of TechCrunch. But for people in my seat, that's our money you're burning. right? And that's where I start getting frustrated. So like, we really focus on the basics, and it's kind of what are the barriers to entry or sustainable competitive advantage of a company, and then let's talk. One conversation I have with all my GPs is like, hey, we're investing at the seed stage, but let's have a conversation about how you guys think about sustainable unit economics at scale in your companies that you're investing in, right? This isn't a question of like, there is this theory in venture, like somebody will always pay you for growth, right? And we saw a lot of companies, incinerate a lot of money that, like where they were offering growth with no path to sustainable, kind of unit economics, attractive unit economics. And that just doesn't make sense. It does in greater full times, but when, what kind of fundamental economic value are you creating? I guess that's the question I'm always asking. What fundamental economic value are you creating? Because somebody will always pay you for that. There's a myth that somebody will always pay you for growth. That growth has to be accretive to somebody, whether that's an acquirer or or a public market investor. There, end rant.
No, it's great. I went back and listened to an interview you did with Ted Seides, Capital Allocators, back in 2017. And Snap had listed not long before that. And you were talking about Snap more or less in the exact same framing and context where you were just now. So you're certainly consistent. And you were diplomatic about it. You weren't harsh about it, but you more or less said, it's hard to line up the aspects you were just talking about with the valuation. And naturally, I was curious and I looked it up. I don't know if you've done this, but I went to see how that's worked out. So in the 7 years since, the share price is more or less where it was then, but revenue is 5x. And I thought that was a pretty great call.
That's interesting.
So
yeah. And
I'm curious when your short book or short fund is.
I'll tell you, I'm really harsh on myself, so I'm glad you did that, because there are a lot of people who just plather on and kind of make predictions and never kind of loop back. The thing that what keeps me up at night as I do kind of self evals is a phrase keeps ringing in my head, and I think Gary Tan from Y Combinator said this a long time ago. He said, pessimists sound smart, but optimists make all the money. Right. And that's something that I worry about, because, I'm kind of a dyed in the wool value guy. Like, I'm a value investor lost in this, kind of sunny and magical, land. And even Swenson said to me once, he says, it sounds like you're playing a value hand in a growth game. And that sticks with me all the time. But at the end of the day, I try to be an optimistic value investor. So that's how I square the circle of, pessimists sound smart, but optimists make all the money.
Take it back to portfolio construction. Mm-hmm. Something I have wondered is, the nature of fund of funds, and especially with your strategy of getting in early with managers, first institutional fund or close to it, helping them scale over time. How do you balance having those huge wins and supporting and sticking with those managers, a first round, which you're very well known for being a, great example, with bringing newer managers into the flow of the fund? Like, how do you approach that as you progress through time?
Yeah, it's funny. It's really funny because it's a hard circle to square, right? Like, how do you support your managers? It's like having children, right? And I love my children equally but differently, and they all keep me up at night, for different reasons. And you have a child, and like they live in your house until they go off to college and then maybe come back. And I feel like that's kind of what happens in portfolios. And so one of the things that, we struggle with a little bit is when to get off the bus with managers. And very often that's a decision that's driven by fund size, right? Your fund size is your strategy. And we do feel like when people get too big, they're forced, even though some people continue to be really good at doing the kinds of things that brought them success. There's a different style of success at kind of a larger fund size. So we probably part ways with managers more frequently. I mean, I should say more frequently, but I don't really know, kind of other people's portfolios. But again, Swensen, I hate to keep bringing up, but he was such a legend and such a formative influence. I once asked Swensen what his secret to success at Yale, which has like the one of the best private equity programs in history, and he said, we get off the bus one stop too early rather than one stop too late. And there's a lot of like inertia in institutional investing, and it's hard sometimes to say, it's hard to say like, this manager has been on a great run. We want to continue this relationship for our existing funds, but we're not participating going forward. That's probably the hardest, kind of aspect of my job. And there's some people who think I'm a jerk probably because of it. Because sometimes this business does feel personal, especially when you've been like very active and involved, in the growth of that firm. But I think, people kind of grow up and grow old. But, our number of GPs has been pretty consistent, per fund over time. And it's, it kind of swells a little bit at times and then, disgorges at other times. But like I said, I love each of my managers equally, but differently, just like my children.
Well, you might have, let's call it 5, but the love isn't, well, I'll leave it at that. I was going to say, it's not entirely equal, right? It's like, well, we have 5. Now, Josh Koppelman might get 40% of my love and the rest of
yeah.
Sure,
some kids are in the doghouse and some kids are, but it's interesting because in 2016, so I didn't want to bore people with this, but I'll talk about it quickly. In 2016, one of our investors came to us, very sophisticated investor, and said, "Hey, look, I see what's happening here. Like, you are backing these new managers and you want to stick with them, while you determine, generally like you're making a 2-fund bet, right? Because that's the amount of time it takes to like turn over the, appropriate cards. So your portfolio is growing, and we're worried, and we love the fact that you're concentrated, but we're worried that the portfolio is going to ossify. So how do we continue to maintain concentration while allowing you to continue?" And we're very militant about raising one fund at a time, because I don't want to have conflicts, and we don't want to be a multi-product firm, and it's certainly not the wealth maximizing answer, but it's been the what I think the investment, I hope, is the investment maximizing answer. Maybe not, time will tell. So in 2016 we raised sibling funds, the Explorer Fund and the Platform Fund. And the Platform Fund was for our kind of most established young managers that that invested in platform or community. So guys like First Round and True and Data Collective. And that was a 6-fund portfolio, right, which is actually really tight. And then we had the Explorer Fund where we did 10 emerging managers. And our investors said, "How do we choose?" And I said, because I hate making investors choose. That's another thing that I always hate doing. And I said, "Look, let me explain it this way. Platform Fund is probably going to be my kid that like does everything right, does all their homework, is captain of the whatever team, and on the debate team, and really smart, and going to go to the college of their choice." Explorer Fund is the fund where that kid's either going to become Picasso or go to jail. And I love them, equally, but I would say, Platform Fund probably has a slightly higher expected return, but Explorer Fund has a much wider standard deviation. And because, the beauty is, the outcomes can be asymmetric, in venture, that could be. And so far it's kind of played out like that. Like, Platform Fund is chugging along, doing exactly, has been distributing nicely. We've been delighted by it. And Explorer Fund, man, there's so much potential. I'm like, man, if you could just like turn in your homework on time, you could like make this happen. But it's like, I actually still think Explorer is going to be my best fund, but it's like, but so far Platform's outshined it. It's like so funny the way these work.
What are the spectrums that you view funds along? So emerging versus established, generalist versus specialist would be kind of your conventional. For you mentioned platform, we'll call it non-platform. Yeah. But how do you Your own little continuums when you're sizing up a fund. What does that look
Yeah,
like?
that's, so it's funny because uh, there's a couple that I think of that that are maybe almost kind of false terminals, right? Um, there's what I call posse versus sheriff, and I might be the only person that thinks about it this way, because I think, and I might be actually be completely wrong about this. I actually think that venture is too big for people to invest comprehensively. Let's put it that way. Now there's riches in the niches, and I think this is kind of where I've most evolved in the last like 10 years. So where I'm going with that is like I just described platform funds. So historically, I've really loved these groups that invest in community platform infrastructure, whatever you call it. Like first round is like my archetypal platonic ideal. And so for a long time, I like looked to replicate funds like that because I thought the challenge of investing was so vast that you needed to be an intelligent switch at the center of this like broadly distributed network that so you could process the world and get to the right answer. And that was like Data Collective in 2011 when we invested there was kind of that. They had this collective that kind of created great leverage for them. What that did is it kind of closed my eyes to I actively rejected the people who I thought were the lone sheriff who were like going to like round up the baddie on their own. So there are a lot of groups where it's a single GP. And that's all, very often, solo GPs are where this becomes most acute, or even teams, are, sometimes people play the game like tennis teams, not like basketball teams, right? Everybody's got their own match. And they're just out there, they're doing their thing. And I thought that was, inadequate to the challenge of investing. And I think I've been wrong on that. So now I think of people on a spectrum, and what I want to figure out is just, are they the best at what they do? Do they have a sustainable competitive advantage wherever they exist along that spectrum? Rather than in the old days, I just said, I play in this third of the spectrum. So that's been a big evolution for me in my thinking. The other axis on which again has been kind of an evolution is and again is understand, rather than making the axis, your position on the active prescriptive, I just want to make sure that you fit and you're authentic relative to where you are on that axis, because some people don't actually realize. It's amazing how little self-awareness some people have. And I'll give it, and this is where this becomes key, and I'll give an example. So, when I was growing up, quote unquote, the answer that, Swenson would give would be like, venture is a catalytic asset class, and we invest in those groups that can be most helpful to their portfolio companies. And then Dave Marquardt at August Capital, fabulously, legendary venture investor, and by the way, one of Swenson's favorites, he once said to me, he said, Douvos, Swenson's got it completely wrong. He's like, he thinks we're going in here and like, puppeteering these startups. He's like, my job is as a stock picker. He's like, if I can help, a company, every now and again. And that actually blew my mind. And then it took like 10 years for that to actually sink in. Because I kept chugging away on this Swenson, like, we must help, we must invest in people who help their startups and have teams that, help them with hiring or with, kind of, some of the platform stuff that I love about First Round. But ultimately, like, some people are actually just really good stock pickers and are really good at finding the best startups. And then never kind of interacting, letting those great managers manage, because that was like something that like I look back and I say, wow, I was like really stupid / arrogant / whatever to say like, hey, actually, we're looking for these people to invest in great entrepreneurs. You got to let great entrepreneurs entrepreneur. And that's something I continue to struggle with.
Well, to use stock pickers and kind of a public analogy, something I'm curious about is your view on fees and fee structures. I know generally speaking, allocators less is good. So I think there's probably, there's that. But namely, I'm thinking about structures. And, for venture, a space that's so focused on disruption, it's striking how homogenous fee structures are. And I'm curious, are there any fee structures that are, we'll call them just non-straight down the middle fee structures, that you would like to see more of, or aspects that you could see brought in from, maybe other types of asset classes where they have fee structures that you think bring alignment, or just maybe a different way of doing something with fees than we see today?
Yeah. It's interesting because I think of it as you got the fee side and the carry side, right? And one thing that's tough is that venture is a very long dated way out of the money asset. And so what that means is hedge funds are taking carry every year, right? And in venture, it's kind of feast or famine. And the problem is you won't really know until year whatever. And I actually think that in some ways that's healthy, in some ways that's unhealthy. But I've always wondered, is there something you could do? And by the way, actually, let me step back a little bit. One thing that I don't spend a lot of time worrying about is management fee, partially because I don't invest with intent in groups where I used to worry about management fee. When you're investing in, kind of a big $1 billion fund, and you're one of the first meetings I sat in, and, in 2002, it's January of 2002, I was at an advisory board meeting, here in Silicon Valley. And the guy who ran Harvard's venture program at the time, this legend named Peter Dolan, had this great Boston accent. He raises his hand and he goes, "You guys should be ashamed of yourselves. You guys took $45 million in management fee last year and $0 for investment." He goes, "You know what that means? That creates a lot of J curve. And when I have J curve, I don't get paid." And there's a whole hilarious story that's really quite long, but so that's, those guys were running $2 billion, and there were 9 partners, right? That's a lot of money to split among 9 guys. The reality is the funds that I'm investing in are so small that I'm actually shocked that some of these, GPs can kind of pay themselves, and keep the lights on. So I'm not worried about management fee, but can we align carry a little bit better? Right. And the thing I worry about is do we have too much raw optionality in venture? Right. And this is a very weak analogy, but I think over the course of the 2010s, Jan 1, 2010 to December 31st, 2019, I think the NASDAQ did a high 3x, right? If you did that in venture, you'd have taken home a lot of money, right? And so there's no calibration against, so I'd almost rather make that trade rather than, hey, GP, you have a really long dated way out of the money option that could pay you a lot, even if you don't outperform the opportunity cost of equity capital. Would you like to could we figure out some way to trade that for something that gets you more interim cash, but maybe actually puts up, some kind of a hurdle relative to, this opportunity cost? I don't know how you actualize that in this very liquid asset class with extremely stale prices, but it's something that if somebody could figure out, I think would be really well loved.
I've got a question for you on references. So, given the length of the relationships and concentration that you have, obviously they'd be pretty important. But I was listening to a podcast a while ago. A peer, different firm, was touting that they'll do 50 different reference checks for a manager. And I have to admit, I couldn't help but hear that and think, wow, that's good marketing for your LPs. I don't know what the 50th reference brought that the 30th different, if I'm being honest. Right. And I'm curious how you approach references and, quality versus quantity.
Yeah. So I love this is, every question is a great question, but this one I particularly love because it reminds me of one of my favorite stories. And what I love is kind of what happened subsequently. So I'll start with what happened subsequently. There's a guy named Gordon Ritter, who is a fabulous investor, started a firm called Emergence Capital. So Gordon was at this Golden State Warriors playoff game and he went to high five the woman next to him, and she just turned away in her excitement. And he just stood there with his hand up for a minute. And this like made ESPN. And it was like the highlight of the day. And then like literally you'd go on Twitter and be like, homie got curved, right? Like everybody was like making fun of this clip. And I'm like, oh my God, that's Gordon Ritter. The dude probably has like, the parlance of Silicon Valley, tres comas, net worth. This guy's been a fabulous investor. And he's like such a nice guy, and I just thought it was hilarious that he became the poster child for like the waiting high five. The reason I tell that story is in 2001 or two, when I was at Princeton's endowment, Gordon brought his firm Emergence through, and at the end of the meeting, this is when everything was still very much on paper rather than being emailed around. Gordo. Is, at the end of the meeting, we were exchanging pleasantries, and he says, "Hey, can I give you guys a reference list?" I said, "I'd love a reference list, but my reference process is really focused on the off list, right?" Like, and he looks at me and goes, "I have the off list in my bag." And he goes to open his bag, and to this day, I don't know if he was joking or he's being like funny, or authentic about it or whatever. But that's a real thing, right? Like I would rather have one authentic reference check with somebody that I know well than 30 like things that appear on somebody's list, because everybody's primed. They've got their story. I've been doing this 25 years almost. I've never once heard something that's like really moved my needle, either positively or negatively, from somebody. There's definitely strings you can pull on. But for me, it's a quality rather than quantity thing. And by the way, a lot of these people on these reference lists are like founders, and I'd rather, and again, I don't want to dismiss it, because there's definitely stuff that you can, but I think the problem is, I guess what I'm fumbling to articulate is, the problem is, in investing, so often people are seeking confirming data, and there's this confirmation bias. And when you're talking to founders who are like on somebody's reference list, all you're going to hear is confirmation. They're not going to say, "By the way, let me tell you about this person's proclivities in this way or that way." Or just like, you get like some canned thing, and that, by the way, they're looking to get you off the phone as quick as possible because they want to get back to running their business. So I love going off list. There have been funds that I've done where I've done 3 or 4 reference calls, and like, then you hold your nose and you leap, because at some point in venture, you're always holding your nose and leaping, whether it's at the company level or at the fund level or wherever. And the fund that I'm specifically thinking of, where I did 3, there are 3 super high quality, authentic references. I did the fund, and that's somebody whose fund I think is going to be the second best fund I've ever invested in. And maybe I'm just lucky on that, but I think that's emblematic to me of like how over-engineered people have made these processes.
So I want to end on a high note here. Do you want to give a shout out to one of your managers or one of your portfolio companies who is just killing it right now, and you're really happy to be associated with them?
Oh my gosh. I mean, like I said, I love
so many you could name.
Oh my gosh, it's crazy, right? Like it's like you're asking me to talk about the accomplishments of only one of my children. So, look, I feel like this is almost like an Oscar speech where I know I'm going to forget people, but look, I love every one of my managers, particularly for the things they've taught me, right? And I've learned so much about investing, even after having invested in first round, like watching them continue to grow and evolve, and viewing themselves as like, not as a deployer of capital, but as a service provider to entrepreneurs. That's been really great. We've got one. I think of actually somebody like Sunil Nagaraj at Ubiquity, right? He's really kind of, or Ross Fabini at XYZ, both outstanding, managers who really taught me. Ross has built a team around himself now, but Sunil continues to be a solo practitioner. But they taught me what it was, that maybe I was looking at the world in too constrained a way. They've built outstanding portfolios and have real depth of domain expertise and thoughtfulness, and I love those guys. I love my I've done a lot of, kind of university / research institute leveraging stuff like the E14 fund that sits at MIT, at the Media Lab, or House Fund over at Berkeley, or Rhapsody that leverages innovations from, a bunch of places. They're out of Boston. Defy, that's my old buddy Neil, and just watching the way they kind of work a crowd. Madrona up in Seattle in my early career, those guys really taught me the value of being idiosyncratic and taking a contrarian bet, because Seattle was a contrarian bet, and they found a bunch of great companies up there. And that first fund that I invested in, I really held my nose, because I had a lot of people yelling at me about alternate geographies and playing. That's when Swenson said, you're playing a value hand in a growth game. And then that fund ended up being like a 7X fund. So those guys crushed it up there. Every one of these people have taught me something, but just like in the Ariana Grande song, like, thank you, next, right? Like, we're always on to the next thing. And every one of those people is still with me and in my portfolio still, and we continue to invest in all of them. But like, for me, it's all about like, what have I learned from all these people, and how's that making me a better investor tomorrow?
That's great. You didn't thank your agent, but overall that was great.
Yeah, my agent. That's probably my agent is probably my kids who are, kind of their, I'm dad ATM.
Well, Chris, this is super fun. Thanks for joining. Really enjoyed the conversation.
Yeah, this was a blast. I really appreciated the opportunity, and hope to be able to be helpful in the future in any way to anybody actually who's listening to this. Just reach out.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.